Good morning, lazy traders. If you like trade alerts, stock talk, and all things investments, please like, share, and subscribe. Today I'm going to be talking about a particular style of trading called dividend capture trading, which this channel is pretty much entirely about dividend capture trading. But I'm going to go over some of the stocks that I like to dividend capture trade and show you exactly why these are some of the stocks I like to dividend capture trade. First one, I'm going to talk about McDonald's. McDonald's is a somewhat of a solid growth company. If we look at the all chart here, and we look at from say even just like 2000 up to current, you see it's about $37 to $315 per share, which is about a 9.5% rate of return. But you see in the chart, even on a 5-year or 1 year, you see the chart is typically an upward trending chart. It's generally positive. And the more positive the trade action is, the less time you're going to spend holding on to a company on a dividend capture trade. Some of the other things that I look for is the analysis of a company. In particular, I look for the earnings estimates. I look for the trending earnings. Some of the trending earnings looks like it's kind of sort of trending down, but for an old growth company, you get a lot of those kinds of up and down adjustments. For McDonald's at this point in time, they are having some troubles with inflation, and the price of their food is going up, and they're getting less foot traffic into their stores. So we're seeing a recess in the earnings estimates going forward. That doesn't mean trouble. That just means they have to rework the business in order to adjust and work this out in some way. And that's fine. I'd still trade this as a dividend capture trade stock. It's a healthy company. It's a great business. Most of their earnings come from basically, I guess in a way you'd say real estate, because their store managers pretty much pay rent to McDonald's to be able to sell their food, is basically how that works, without getting too deep into the weeds on it. So another one might be like Clorox. That's a good one too. See, a positive upward trending chart. Some of the things that you might want to watch out for as time goes on, abnormalities like the COVID-19. When that hit, Clorox spiked to unreasonable levels to about $236 a share. And it's come back down since then. It's very reasonable. I would definitely dividend capture trade this stock. Going forward, the analysis. Yeah, and in this case, we see an increase in the estimates going forward for Clorox, for the most part. So for the current quarter, we've gone from $1.31 to $1.40. So we're not really seeing a whole lot of issues with their ability to perform as a company in this sort of economic environment. And I think their forward projections were pretty much as expected they should be on a typical company like this. So there doesn't seem to be any negativity or surprises. So after we've kind of sort of gauged and looked at some of the things with some of these companies and how they're growing, kind of sort of to take into consideration in comparison to dividend capture strategy, some of the things that you might want to look for. So your initial investment, we'll start with the price of McDonald's on January of 2000, which was $37 a share. I'm not going to include the change. I'm just going to say $37 a share. 0 monthly contributions, length of time in years, I'll just say 24 years, so we've held it for the last 24 years. Estimated initial rate we'll call it 9.5%. Then you just calculate it, and you get about $326 per share, which is on the high end. It's probably more like 9%. Try that. Okay, so it's somewhere between 9 and 9.5% in overall average annual compound rate of return on the share price of McDonald's. The dividend yield has been historically about 2.5%, so you'd want to throw that in there as well. But with a 5%, even if it was like 5%, it would take 18 years for it to double. So I don't think you'd even quite get double on 2.5% over 24 years. You might, but I don't know. Otherwise, you look at what you're doing with dividend capture trading. So far this year, just anecdotally speaking, I don't have 24 years of history to back this up or anything, but if you think about it and compare that to what I have now at 24% over just the first 7 months of trading, basically you're taking something that has very little growth and then you're using it to actually get more growth out of it. That's risky, but if you do it properly, you can really increase your income this way. So one of the things that I like to do is I like to get a little extra share price for my trade. So if I bought it at $20 a share, I want to be able to see if I can sell it at $20.10 a share after dilution of the EX dividend payment date. So if I do that for all of my trades for the year, at the end of the year, I can take the dividends and spend the dividends on something, and then the amount of money that I made on the share differences, I can put that and reinvest that back in to capture trading more stock later into the next year. So if I was into actually just spending some money, I could kind of sort of divide that in two different ways if I really wanted to. That's an advantage. The disadvantage, of course, is kind of twofold. One, you're trading stocks. You could always run into that situation where you pick a loser. And if you do pick a loser and say you lose 5% and you sell out, then you're going to have to trade at least 5 more stocks or the next 5 stocks positively by 1% in order to get that back. So it's really kind of sort of it's kind of sort of a heavy hit to take even just a 5% loss, because with like 18 trades in 7 months, it's going to take you a third of that time in months to actually catch that back up again. So these are some of the things to think about as a dividend capture trader, and hopefully I've taught you something that you've learned about dividend capture trading that can help you if you're interested. Just one more thing before I go. Taking a look at the initial investment of $37 per share as a share price for McDonald's, and say the 9% interest rate of growth over a 24 period of time. Let's say instead of 9%, which gave us a $292.71 share price, let's go ahead and assume that it was a 24% growth rate. $6,461.33. That's huge. I would definitely be interested in going for that instead, if you can do it. That's all I have for this video. Thanks for watching, and stay